Cool. Thank you very much for waiting.
That's worth about 10 trillion.
Hi everyone. Thanks a lot for coming. Today we're very happy to have Jonathan Macmillan here, and Jonathan Macmillan is a pseudonym for a banker and an academic economist who together co-wrote the book The End of Banking. And the book's available in 9 languages and has been discussed among central bankers, finance professionals and academics. The person tonight presenting is the banker, and he's a financial expert who loves nothing more than digging through balance sheets, systems, flowcharts and transaction data. He has first-hand insights from working in London, New York and Zurich. So without further ado, take it away.
Thanks for the introduction. Insanity. That's trying the same thing over and over again, yet expecting a different result. That's kind of the thing I always have to think about when I think about how we deal with the problems of finance today. Ladies and gentlemen, many thanks for coming here tonight and listening to me tonight. Well, this quote has been attributed to Benjamin Franklin. Yeah. I know many of you are concerned about things like climate change or social issues or environmental issues, and maybe you ask yourself, why I'm here today? Why do we talk about banking today? It seems to be a bit a remote topic these days. I'm convinced this insanity of finance, if we don't deal with that, then we will have a very hard time to deal with all the other issues that we're facing today. And one thing is clear. If we're trying it the same way over and over again, it will not work. We have to try something radically different to bring back sanity into finance. I'm not just talking about like ideas or trains of thought. I have a very specific plan in mind, and I'm going to talk about that. And it's a plan I developed together with, as you said in the introduction, with my friend. He's an academic economist. I'm the banker. So we put it together. We wrote everything down, put it in the book, and then we called it The End of Banking. Felt pretty bold at the time when we came out with it. It was 2014. But nowadays, this is the middle of the mainstream today, right? And when you see the subtitle, it's about the digital revolution. Of course, digital revolution. The new technologies, they disrupt everything, right? And the old banking institution is going to be those dinosaurs. They're going to be swept away by the blockchain, peer-to-peer lending, all those new technologies. Even the banks, they don't like to call themselves banks anymore, right? So it's very mainstream. But wait a minute. I mean, the computer was invented 50 years ago. And finance is, maybe besides pure tech, one of the most virtual industries you can imagine. It's just numbers and figures, nothing more. And yet, we are writing the year 2019 and we're still talking about this disruption that will happen at some point in time. Truth is, this revolution already happened. It already happened 30 years ago, and most people don't realize. We wish it would look like this, but in reality, this is how the digital revolution in finance looks like. This is a chart put together by the Federal Reserve staff, by staff of the Federal Reserve Bank of New York, and it shows you the financial system at the eve of the financial crisis of 2008. It's not exactly disintermediated or transparent or efficient. And it's important to understand how we end up here. So we have to start what banking was before it was disrupted. And for this we have to go back and look at how traditional banking looks like, why we have it, and how it evolved with time. And for that we go further back. And first question to answer is why we have banking. And when you think about our economy and we think about people who need money to invest it and people who have idle money they would like to save, they have different needs, right? Because lenders, they need large sums of money. They committed long time to build a house or invest in a factory, and they also put the money at risk. If their business ideas go south, so does the money. Savers are quite different. I mean, they only have usually small savings at their disposal. They need liquid and immediate access should some need arise, and they also can't put it at risk. They can't put their existence at risk for a lender. And that's why we have banks in the middle. They kind of bring those differing needs between lenders and borrowers together, and they do it with a business model called banking, or more specifically, fractional reserve banking. So, I apologize in advance because we're going to look at very few balance sheets. I think it's necessary just to kind of get the basics and then continue from there on. So we keep it really simple. What is a bank? What is a bank doing? And what does that mean for the broader economy? Can you read the stuff here?
Yeah.
Good. It's a bit small. So we start up at the top left. And on the start we have Alex, a wannabe banker. So he wanted to become a banker. He has some cash. We assume he has 80 pounds in his pocket. And with that he incorporates the first bank in our economy. And you can see this step on number 1, where he establishes a bank. And on the balance sheet what happens is the cash is put on the bank as an asset, whereas on the liability side you see that Alex equity is basically financed with it. So the bank is now alive. It's existing, it's waiting for customers. And one such customer comes along. She's called Sarah, and she would like to, I don't know, open a coffee house. She doesn't have money on her own, so what does she do? She goes to a bank, she applies for a loan. Alex thinks Sarah is creditworthy, so he decides to extend her a loan. Many people think now that Alex will go to the vault and get some cash out and hand it over to Sarah, but that's not what happens, right? I mean, when you apply for a loan and you get the loan from the bank, they would write or open a deposit for you. And this is exactly what happens when you look in step 2. Alex would record a loan to Sarah as an asset because he gave the loan out, 60 pounds. And then he opens up a deposit for Sarah, 60 euros. And you can see that this banking corporation, it grew. Now, before it was 80 pounds in balance sheet size, now it's 140. And the amount of money that this economy has increased as well. We started with 80 pounds in cash, but the 60 pounds of Sarah, they're as good as money. She can use her debit card, she can instruct wire transfers, she can do anything what she wants. It's like money. And that's what she does in step number 3, where she starts buying the equipment she needs to get her coffee house started. So she goes to Ryan, who sells coffee roaster, and she buys the coffee roaster, and you see then the 60 euro are transferred over from Sarah to Ryan. And now we see already how banking works. Banking is about the creation of money out of credit. So banking do two things. They supply money and credit to the economy so that people can stem the investment and that people can make payments. So already almost everything in traditional banking is within this example. Now what we see here is just the exact repetition of the very same thing that what happened before. The only difference now that the second borrower is now called Sarah, she's now Julia, but she again gets a loan of 60 pounds. She opens a coffee house, and in step 5 we then also see how Julia buys the equipment from Ryan, and now Ryan has a deposit of 120 euro. We have 120 pounds, we have 80 pounds of cash, and we see that the money supply grew that are extended. more thing. And we see, I mean, banking has some magic to it, right? Because banking can create money out of credit. It's really a remarkable thing. But it does so at the cost of fragility. And in step 5, you can see why that's the case. Because if Ryan comes now to Alex and say, hey, I want to get my 120 pounds in cash, well, Alex has a problem, right? Alex has only 80 pounds in cash. So he will get bankrupt if Ryan decides to pull all the cash out of the bank. And that's the fundamental fragility of banking. If that happens, Alex goes bankrupt, Alex can no longer extend credit, so no one can open coffee shops, no one can do payments anymore over the banking balance sheet, and the whole economy gets into a downward spiral. For completeness sake, when money is created, it can be destroyed again. And money is destroyed when loans are repaid and not extended. And you see that here on the step 6 and 7 of our example. So we would see that in the 6th step that Ryan would buy coffee from Sarah, the 60 pounds go back and she can repay the loan in step 7. And then you see how the banking balance sheet collapses again. But that's just for completeness. This is important. This is very important. Banking is fragile, and if it breaks down, then we see scenes like this here. Banking panics. And banking panics happen because everyone knows there's not enough cash in the bank. I mean, Ryan knows it too. And if Ryan decides to run the bank, then Alex is bankrupt. And as every depositor knows this very fact, they are always prone to runs. And when that happens, the entire economy gets damaged as well. And this is a society. So regulated. So what do you do is if government hate that hit if no man. If the government no longer has keeps his money. Because even if two decisions matter for him, so he's positive and also the central bank acting as a lender's resort. There are various of privileged banking institutions. And this medicine is effective. No one's scared anymore because guarantees. The undesired about that thing, right? You involve people with risks as if they would otherwise do if there's not an insurance in place. And then you can't just purchasing. You can't just guarantee bank. If you have additional regulations in place, you need to put capital requirements in place, liquidity requirements. You sure Alex don't go wild with the government. You could make a carrot and stick approach. So carrots, privileges, stick, constraints. As I said, this excessive risk taking is a very abstract thing, right? What would you understand under excessive risk taking? So let's look at an example. And that's the real world example. So imagine we're like bankers, we would bet lots of money. Let's talk about 35 billion pounds. So we go to the casino, we have 35 billion pounds. And we'd like to do a bet. And we go to the casino table, and we have the following idea where we can win money. So we have 35 billion, and we put 1 billion each on the numbers 2 to 36. So we leave no money on number 1, and of course there's a 0. But on 35 numbers, there's 1 billion pounds. It's at a good, where we can expect investment strategy, and if we play it over and over and over and over again, we can say whether this is a good investment strategy or not, right? It's pure mathematics. So there are 37 outcomes, right? Because there's a number 0 to 36. In 35 cases, we're gonna win 36 billion pounds. But in 2 cases, we will win nothing. And then, of course, we have to divide it by all the numbers of possibilities. And then we have to subtract our initial investment, 35 billion pounds. Now, unsurprisingly, with this strategy, our expected profit from playing it each round is minus 945 million pounds. So we expect to lose roughly £1 billion every time we put 35 billion pounds on the casino roulette table. Which makes sense, right? Because the casino wants to win. Very simple. Does that make sense? Good. So it's a stupid investment strategy, right? No one should do it. It's silly. But as I said, we're bankers, right? We're not playing with our own money. That doesn't make any sense. So we try to find someone, and we want to borrow 3,465 billion pounds. So then we have overall 3,500 billion pounds to bet on. We just leverage our bet by the factor of 100. So that means instead of 1 billion on a number, which is pretty boring anyway, we make 100 billion per number, which is much more fun, right? And this is the same strategy. So 100 billion pounds on each number, 2 to 36. We leave 1 and we leave 0 empty. And now we look at the payoff again. And the payoff changes because most of the money we borrow. So in 35 cases, we're going to win 3,600 billion pounds. It's 36 times 100. And then, of course, we borrowed the money, which we have to repay. We even added some interest, 1%. So we have to roughly repay 3,500 billion. So we have a 100 billion pound net profit that remains with us in the leverage case. So in 35 cases, we win 100 billion. And in 2 cases, of course, we lose everything. We lose 3,500 billion pounds. But we don't care for the 3,465 billion pounds. They're not ours. It's not our money that is lost. We only lose 35 billion pounds. And now, of course, it shifted. A stupid investment strategy became amazing, right? So now, because we win 100 billion pounds in 35 cases, we only lose 35 billion pounds in 2 cases. You calculate it together, you calculate probabilities, you get an expected profit if you play it over and over again for each round of 60 billion pounds. It's great. If you ever have the possibility to do this, then go for it. It's the best thing you can do. The problem is you need to find someone who gives you money that you can gamble in Las Vegas, right? That's the problem. Because if you're the guy lending money on this investment strategy, then your expected profit is, very low. Because you can only win the interest, but if the number 1 or 0 appear, you lose like 3,465 billion pounds. So that means it's terrible. So you will never find someone. You will never find someone who will give you the money for this investment strategy. But now imagine you can talk to your creditors, your potential creditors, and you tell them, I have a government guarantee. So you don't even have to care what kind of investment strategy I'm going to do, because no matter what, the government will make you full. You will never lose a single cent. And then, of course, the creditor, for the creditor, it doesn't matter anymore whether 1 or 0 or 5 or 36 turns up, because the gambler or the government will repay the money to the creditor. And now we have a situation where everyone involved benefits from a really crazy investment strategy. Everyone involved will participate in that. And that's the fundamental problem of moral hazard and excessive risk-taking. Because in the end, the bill is going to the taxpayer as soon as the number 0 or 1 is going to turn out. And it will happen eventually, right? Because as long as you play roulette, any number can turn up. And this is why it's so important that when you have guarantees in place that you can impose constraints. And it's also important to understand, if you have the possibility to go to Las Vegas and do this kind of strategy, it's called a tail risk strategy, right? And if you can put the tail risk onto the taxpayer, then you can make enormous amounts of money. It's extremely profitable. And that's why those regulations are so immensely important. If they don't work, then our bankers go to Las Vegas. Now, what happened now? So we talked about banking in the industrial age, how it works, and we saw the fundamental problem of banking because it's fragile. We have to put privileges in place, deposit insurance and lender of last resort to avoid panics. This gives excessive risk taking, which is a big problem, and that means we have to regulate it again with capital requirements, with liquidity requirements, with all kind of supervisory things. Now we come to the digital age, right? And now we want to understand how did we get from this traditional banking model to this complex beast. And now I zoomed into this picture very closely in, and what we see is the mortgage-backed security, this kind of the signature product of the financial crisis. So you see here on the asset side loans, and they are securitized into so-called mortgage-backed securities. You need information technology to do that. You need computers to calculate the risk, calculate the prices, trade it on electronic markets. This is where the digital revolution in finance went into. And it looks like a very sensible idea, right? I mean, you have like loans going to the borrowers who build houses, and then you tranche it and securitize it and sell it to investors who want to basically be lending those money. Looks very reasonable. But it's just a small part of an entire chain of financial commitments. You have like much more additional like refinancing balance sheets with repurchase agreements. You have like resecuritization of the mortgage-backed securities, they're called CTOs, and so on. And then you zoom out again and you see like this entire picture. Now, what we tried here is just to reconstruct basically the exact same example with these new financial products. It was later known as shadow banking after financial crisis happened in 2008. And yeah, you can see it's much more complicated, and there are much more balance sheets involved. But in the end, the purpose is exactly the same. You create money out of credit, and then you supply the economy with it. And you also have the exact same fragility behind it. If people start to run on those shadow banking balance sheets and institutions, there's not enough cash here to satisfy the demands. So you have the same bank run problematic in a shadow banking setting as you have it in a traditional bank setting. The example here is really the most simple possible example you can imagine using shadow banking techniques. In reality, it's much more complicated than here. And shadow banking is really important. Before 2008 in the US, it became bigger than the traditional way of banking itself. That means more money was transmitted from lenders to borrowers via shadow banking than within traditional banking channels. And this really begs the question, why? I mean, it's super complicated. It's extremely expensive. You need lawyers to create those special purpose vehicles. You need highly paid bankers to create those security tranches. And then you need to do so many transactions between so many balance sheets just to achieve the same thing as you did before on one simple balance sheet. Doesn't make any sense. And now we come back to the regulation, which we talked about before. It's the constraints. I mean, if you have like rules that prevent you from going to Las Vegas and engage in those highly profitable, excessive risk-taking strategies, then you will do everything to circumvent those constraints. And in the industrial age, it wasn't possible to really circumvent it because everything was done on pen and paper. Everything was on one book, on one balance sheet. You recorded all the transactions and loans and deposits on there. And as a regulator, it was very easy to control what's going on. But with the digital age, it changed. Because now banks could slice and dice and redistribute money and credit over several balance sheets without any problems. And of course, regulators would see that. They would see like securitization plays a huge role, and they would devise new rules to make sure the banks don't abuse these new financial innovations. to circumvent the rules. But by the time those regulations are implemented, they already devise new rules. And then you play this game over and over and over again, this cat and mouse game between banks and regulators, and then you end up with that. And then you come up with a shadow banking system that is immensely complex, immensely expensive, and immensely fragile. Financial technology to circumvent any constraints that are imposed upon them. And of course you can hit them down, but there will be lots of other models coming up. This is of 2008. When we look at the notches of regulations written to control the behavior of banking institutions, clearly that's not true. When you look at the number of pages published for the so-called Basel Capital Accord, which is a global framework around banking, we see in the 80s and 90s there were like a couple of dozen pages published, and then in 1995 it exploded. Hundreds of pages written every year to play these cat and mouse games with the regulators. Of course, doesn't work, doesn't help. And this is a true story about digital disruption of the financial system. This is what happened. This is how our system looks like. And as long as we continue in this way, we shouldn't expect anything different coming out from new financial technologies, be it the blockchain or peer-to-peer lending or anything else, than adding to this system of shadow banking. So yeah, in the beginning I promised we have a solution. We designed a new way to regulate the financial system, where you can basically prevent this entire thing from happening. You need to unwind this outdated regulatory framework. Constraints don't work, banking regulation doesn't work, so let's stop doing it. Why bother doing something that doesn't work? But if we don't have any regulations, we know we can't control excessive risk-taking. Therefore, we cannot also have the privileges. We cannot have deposit insurance. We cannot have lender of last resort. We can't have any of that stuff. Unfortunately, it doesn't end there. There's still a problem we need to tackle. Because as long as there is systemic risk, as long as the failure of any kind of banking institution can threaten the entire economy, we will not be able to credibly remove those privileges. For example, when you think about the Lehman Brothers in 2008, that wasn't a guaranteed institution. They didn't have any explicit government guarantee or access to a central bank as a lender of last resort. This was just, all the rules were thrown overboard to save Lehman. Because as long as there is systemic risk, then we can try and ex ante prevent or promise that we will never bail out a financial institution. But when then the financial crisis happens, we will throw those commitments overboard. It has happened countless times in history. So we need to find a way to deal with the systemic risk. And for this we need a systemic solvency rule. If you boil it down to the simplest possible way of explaining it, it's an investment advice your grandma could have given. Do not speculate with borrowed money. Because if everyone does not speculate with borrowed money, it means no one can get bankrupt out of financial speculation. Means we don't have any systemic risk. You can also think about it differently and imagine that every corporation in the economy is a domino stone. And now the systemic solvency rule would prescribe the minimum distance between each of those corporations. So if one of those balance sheets or corporations falls, that it cannot touch any other corporation. It has to apply to all companies, not just banks or financial institutions. Otherwise we have this whack-a-mole game again. And then it prevents domino-style chain reactions. But it also means once we implement the systemic solvency rule, all the kinds of banking that we looked at before, traditional shadow banking, any kind of money creation, will no longer be possible. So what it means is we will have finance without banking. Now, what does that mean? I mean, a lot of people would say, well, we need banking, right? We can't do without banking. But when we look for what we think we need banking, there are like these economics textbook reasons. We need them for pooling and diversification, right? As a house owner, how can we get enough big loans together to build our house? Or for diversification. If I save my money, how can I diversify my saving and lend it out to many different people? Well, we don't need banking for that. When we see like direct models like crowdfunding and peer-to-peer lending, they prove that you don't need banking to achieve those targets. The second reason is these information asymmetries. I mean, who's going to make sure only creditworthy borrowers get loans? Also here, we have seen countless new models to address information asymmetries in the digital age. I mean, they're called information technology, right? So there are many new ways and even better ways to deal with the questions, how do we make sure the borrower is the right one that we selected and how that the borrower actually repays the loan. And the third one is the liquidity thing. We thought we need banks because otherwise we're no longer flexible. We give a loan to someone and then we're stuck with that loan for years, no matter what happens. But also that is not true anymore. I mean, you can sell those loans before they mature, right? You can go to secondary markets and you can go to the eBay for loans. There will be electronic marketplaces where you can buy and sell those loans at very minimal spreads and not high market liquidity. So also for that, in the digital age, there is no longer any reason to have banking. And the advantages of a financial system without banking are even more striking. Banking means systemic risk, and with systemic risk we have fragility, and with fragility we have the recurring financial crisis. So without banking and without systemic risk, of course there will be up and downs in the economy, that will always happen, but it will no longer be the case that the whole economy can collapse like it did in 2008. And when we don't have the fragility anymore, we don't need those regulations anymore. We don't need systemic risk regulation anymore. We can get away, we can get rid of capital requirements, liquidity requirements, and the like. And of course, we don't have the problem anymore that we have excessive risk taking. This is a major source of income redistribution from financial outsiders to insiders. And without banking, it just falls away. And finally, it will be a financial system where there's complete transparency, because every loan is given into the real economy. There's no longer financial intermediation. If you have money and you save it and you lend it to someone else, you always lend it into the real economy. Today, if you have money on a bank deposit, you have no clue whether the money is ending up in something which you kind of agree with. Maybe some company that protects the environment and upholds like social standards when they employ people. Maybe that's the case. But maybe it goes into a coal plant or into a company that burns down the Amazon rainforest. You have no idea. You don't know. But in a financial system without banking, there's no way for you not to know where your money is invested. So if you invested in that coal plant, you have to consciously do it. And I'm convinced that individuals, they're unlike corporations, they care more about more than just risk and return. So this can really be a game changer in how we address social issues. By establishing this transparency, but also by making everyone accountable for the decision they make as individuals. So I'm already coming to the end, and I start with a quote. So, and a reasonable person would adapt the world to himself, and an unreasonable person would persist in adapting the world to himself. And yeah, we have talked over the last couple of years with really hundreds of people about that idea, and we realize like many people agree with our line of reasoning. Say, yeah, that absolute. I mean, no way capital requirement's going to work. Yeah, banking, you can no longer regulate it. But then they disagree with our proposal. Well, they say it's too radical. It's too far off from where we are today. It's politically not feasible. It's basically that the powers of the status quo are too strong, and that's why we should still try small steps in improving gradually what's happening in the financial system. And yeah, I mean, when we reject radical proposals just on the grounds that they're unreasonable, that we can't put them in, that means the only course of action we have left is these small steps, everything we tried again, right? Like capital requirements or liquidity requirements, more banking regulation, more central bank intervention, all the things that we have tried over and over and over and over again. I mean, if you still believe that you can have like a small approach and a gradual approach, let me break it to you. I mean, it's not going to work, right? It's not going to change anything. I mean, we tried it. It's insane to think that it will work this time. Everything we have done after financial crisis is just more of the same, and it will not spare us the next financial crisis. So next time, when the next financial crisis hits, then either we are unreasonable, either we are unreasonable, or we are insane. Yeah. Thanks.